Hello and welcome everybody. My name is David Bassens. I'm an associate professor of economic geography at Vrije Universiteit Brussels. I'm also a treasurer of the Global Network on Financial Geography. On behalf of the Regional Studies Association and my co-organizers Karen Lai, Dariusz Wójcik, and Duncan Lindo, I want to welcome you to the second FinGeo Virtual Seminar. Today's talk will be given by Vladimír Pažitka, who is based at Oxford University. And the theme of today is Financial Centers and Investment Banking Networks, Insights from 5 years of Early Career Research. The theme of financial centers can arguably be considered a corner piece of financial geography, and investment banks are clearly some of the key intermediaries, if not the key indicator species in financial centers of the world. So I'm particularly thrilled about this theme, and also particularly thrilled that we can offer early career research as a platform. In this case, a platform for Vladimir, who has received the FinGeo Doctoral Dissertation Prize in 2019. Before I hand the floor to Vladimir, just 2 housekeeping notes. First, as the seminar is being recorded, please mute yourself throughout. You're welcome to leave on your video. That's up for you to decide, but please mute yourself. And there will also be ample time for questions after Vladimir's talk of about 30 minutes. What you can do is already put your questions in the chat during the talk. I will then use these to moderate the Q&A afterwards, and you will be prompted to unmute and you can ask your question, or you can also just put your question after the talk, and you can simply put a question mark in the chat box, and I will give you the word then. So without further ado, Vladimir, you have the floor.
Right, thank you very much, David, for the introduction. So I shall share my screen so you guys can see my PowerPoint. So let's hope this works. Right, so. Okay. I hope that's displayed correctly. If not, please shake your head, David. Right. Basically, this is a topic that I have been working on basically since before my PhD studies, starting as a research assistant, working with Dariusz Wójcik, and then later, I've extended this research into my doctoral thesis, and then I still somehow haven't had enough after doing my DPhil, and I decided to extend this research and carry on as a research associate in finance and geography, working yet again with Dariusz Wójcik on his ERC CityNet project. So, and what I would like to do today is to basically go over what I've been up to for the last 5 years, and I obviously won't be able to mention everything that I've done, but I'll focus on some of the highlights of my research and collaborations that I've worked on, and will perhaps provide some additional insights as to how one can do research on financial centers and their networks. So the first obvious question is how can we observe financial centers? And there are of course many things that we could observe, right? So as you can see around the edges of my slides, one very obvious way to observe financial centers is to look at the buildings, the architecture of them, right? Which is kind of perhaps the most obvious element that meets the eye. But there are other, perhaps even more important elements, such as the people that work there, the firms within which they are organized and employed, the IT infrastructure, and perhaps to some degree, most importantly, financial transactions, which I would like to argue are effectively the lifeblood of financial centers. And this is something that I use as the basis for my research on financial centers. And the reason being that for one thing, there is enough data available on major financial transactions. We are talking transactions made by companies rather than individuals. And there are effectively comprehensive records of certain types of financial transactions available in academia through to various subscriptions that kind of float around universities, and some also sort of proprietary sources which are maybe less available but useful nevertheless. And as examples, obviously this is not by any means an exhaustive list, but there are companies like D-Logic, Thomson Reuters, Bloomberg, Bureau van Dijk that collect this type of data. And the first one is not terribly widely available, but the other three are quite commonly available, to my knowledge, across universities in the UK and elsewhere. So I like to think of these transactions as being in the academic domain. So, and just to elaborate on the types of financial transactions that there is data on. So, for example, initial public offerings. So these are effectively the transactions when a company issues its equity shares to the general public for the first time. So the records of these are for all practical purposes fully comprehensive, because when companies go public, they have to issue documents that accompany their offering. They have to register their shares with stock exchanges. So these are kind of easily trackable. And there are season equity offerings. So these are additional offerings of equity securities that companies make after they go initially public. Bond issues. So these are debt securities that companies can issue. Convertible securities. So these are effectively debt securities that are under certain conditions convertible to equity shares. Syndicated loans, these are typically very large loans for corporations, which are provided by a group of banks rather than a single bank due to their size and the risk exposure. And finally, mergers and acquisitions. So these are transactions when a company buys a significant share or whole other company. So now one can of course ask, what can we actually learn from financial transactions as geographers? Because oftentimes financial transactions are portrayed as something that kind of is happening in abstract space and that can't be easily pinned down, and that's very sort of aspatial in nature. Although with a little bit of work, we can extract interesting things out of them. So for one thing, the monetary valuation of financial transactions allows us to quantify the volume of financial services provided. So this in itself is still potentially something that is not really pinned down in space. However, once we work out who the parties are to these financial transactions, and we learn where they live, so to say, so we learn where these companies are headquartered, then all of a sudden we are able to pin down financial transactions in space, yeah? And this can be done in a number of ways. There isn't kind of a natural way to it, but it can be done, for example, by the location of service provider, it can be done by location of client, and there can be other ways. For example, for certain types of transactions, they can be tied to a stock exchange, or they can be tied to where these securities were issued or who provided the funds. So there are kind of number of ways how to do this. And additionally, perhaps even more interestingly, financial transactions being effectively records of interactions among both financial services providers and their clients, they can actually give us some good insights on the relationality of finance. And examples of this are, for example, we can learn a lot about flows of services from providers to clients. So we can basically work out who provides financial services to whom. We can also learn about how financial services are oftentimes co-produced. So with retail financial services, oftentimes there is just one provider. For example, you go to a bank and get a loan, right? But when it comes to more complex financial services provided to companies, they oftentimes are co-produced by banks, by accounting firms, law firms. Sometimes stock exchanges are involved. Oftentimes also there are multiple banks that kind of in cooperation with each other deliver a particular service. For example, if it's a very large syndicated loan. And this means that basically by observing these records of financial transactions, we can learn a lot about how financial services firms collaborate with each other, how they collaborate with different types of firms, such as accounting and law firms. And we can also work out who they serve, who their clients are. So just to kind of show you some examples of things that we've learned from financial transactions. So for example, in this case, we looked at investment banking revenue for the whole world and how it evolved over time. And here it's quite interesting to see that despite the global GDP and even the global stock markets having very much recovered from the global financial crisis, and both are now at a higher level than was their 2007 peak, investment banking fees have actually never recovered. They are now, or as of 2015, they were at about 60% of their peak levels during 2007. And in this sense, investment banking can be actually thought of as a shrinking industry, which is an interesting thing to think about. Because oftentimes we think of economies just kind of expanding endlessly, but there are certainly industries that do shrink and obviously has consequences for those involved. Then to live up to the promise of this talk being about financial centers, we have in fact done some analysis at city level, where we are talking about financial centers proper. And this is a graph that shows investment banking revenue earned by firms located in New York and in London. And this also shows us something quite interesting, that two world's leading financial centers, so these are the biggest and most internationalized, if you like, financial centers in the world, both of them are not necessarily trending upwards in terms of their size. They're kind of going, or have been going sideways, if you like, in terms of their revenue. However, in contrast, there are other financial centers. I use an example here from China that have been growing rapidly over the same period. So if you look at the four leading financial centers in China, they've all grown rapidly, and interestingly enough, even more so for mainland China. So actually the three main financial centers in mainland China, namely Beijing, Shenzhen, and Shanghai, have by now actually overtaken Hong Kong, which has been always seen as the financial center of China and the gateway to global capital markets. So this is quite an interesting observation, in my opinion. So, and what we've also learned by digging into these financial transactions a bit deeper, that different financial centers are not just smaller or bigger versions of each other, but they are actually quite different, and there are different types of financial centers, if you like, in terms of how internationalized they are, how connected they are, and how they operate in terms of kind of the general business models. So what we look at here is the relationship between service provider and client, and we categorize them into four categories. So the domestic category means that both the service provider and the client are headquartered in the same country. So this is basically, say, Barclays serving AstraZeneca, and it kind of, it's all within one country, in the UK. Then the import category is defined as a bank located in a particular financial center. So for example, this could be a bank located in London, which is, however, not British, but it has a foreign parent. So this could be, for example, JP Morgan subsidiary in London that serves British companies. So this is something that we think of as an import of financial services through the particular financial center. And exports are defined as service providers that are located in a particular financial center and have a parent located in the same country that serve clients abroad. So for example, in the case of London, this could be Barclays serving clients in Germany or in France, yeah, but through its London operations. And then finally, the most interesting, in my opinion, is the platform category. And here we can see, for example, in the case of Hong Kong, that the platform category is actually quite substantial. And what this means is that banks located in this financial center have a foreign parent. So this could be, say, American and British banks located in Hong Kong who serve clients outside of Hong Kong. Yeah. And if we look at the bigger picture, again, there are actually not many financial centers that kind of have significant platform activities. I mean, consistently looking at this, there are sort of three really: London, Hong Kong, and Singapore, where there's significant platform element. And in London, this has been termed as the Wimbledon effect, yeah, where the foreigners play on London's playing field and they win all the prizes. Yeah. Interestingly enough, I mean, London has been very notorious, therefore, especially big American banks doing very well. And you know, if you look at Hong Kong, they seem to be doing even better at this. Yeah, they seem to have even stronger Wimbledon effect. Yeah, and then of course there are other financial centers which are kind of much more domestically orientated. So if we look at, say, many second-tier American financial centers, so for example, Atlanta, Georgia, Cincinnati, Charlotte, Pittsburgh, like they are almost exclusively focused on domestic activities, meaning American banks serving American companies. And this is quite similar actually also for other countries like China. Yeah? So if we look at financial centers like Shanghai, Shenzhen, so as I've shown earlier, they've grown very rapidly. However, they haven't yet internationalized in the sense that they would serve a significant proportion of overseas clients. They are very much focused on the Chinese market. And this is something to keep in mind, yeah, that financial centers actually can operate quite differently and can focus on different types of activities, different types of clients, different geographical areas. So they are definitely not just kind of smaller and bigger versions of each other. So as my first research project on financial centers back in 2015, when I actually started working at the School of Geography in Oxford as a research assistant, we asked ourselves, what is it that turns cities into international financial centers? And to answer that question, we've collected a lot of data. So our initial data set featured nearly 600,000 financial transactions across primary issues of equity and debt securities, syndicated loans, and M&As. And we sourced this from Dealogic databases. And what we found, that the kind of key factors that we identified that matter to financial centers are institutional factors, so rule of law, enforcement of contracts, labor markets, and size and internationalization of domestic non-financial companies. So these are effectively potential clients of financial centers, yeah. And what kind of I found quite striking about this was that it almost seemed like it's all kind of out of the hand of the actual financial services firms. It almost seems like it's all about the environment. Yeah, however good the institutional environment is, you know, whether you've got you know, good labor markets and good labor laws, and of course whether you've got a decent stock of domestic clients, yeah, to properly on the way to become international financial center. And despite, you know, us having a lot of fun with this paper, it still kind of left us thinking that there must be more to the way financial centers work and to the role of financial services firms within them. So we started asking ourselves, what is it that financial services firms could do kind of proactively to develop their financial centers rather than just having their fortunes driven by other actors. And this brought us to thinking about the role of network connectivity and how financial services firms can develop networks that connect their financial center to the rest of the world and open up new market segments to them, new collaborations, and effectively can propel their financial center on its developmental path. And this, of course, was a good idea. However, it boiled down to how to actually operationalize this. How can we actually measure these network connections? Yeah. And we initially started with looking into what is currently available, or what was currently available in the literature. And we came across research on the so-called World City Network, which tries to do something very, very similar as we were thinking of. So it focuses on mapping out network ties among cities, which is, well, in effect, exactly what we were trying to do. So we thought, like, okay, that's it, but it worked out. Yeah, we just need to collect some data and yeah, off we go. But the more we read up on these methods and the more we learn about them as kind of necessary process of doing research, our dissatisfaction with them grew in a sense, and we began to feel that, you know, although this was definitely a good step forward, given that before there wasn't really any empirical research on these types of networks, at least not quantitative research, we felt that there are numerous issues with these methods, and they most importantly didn't capture or didn't observe interactions among cities. Yeah, so the interactions that were supposedly there were effectively assumed in these models and in these projections of network ties rather than observed. And we felt that it would be for the better to actually observe some interactions and then work with such data rather than to use projections that derive from where offices of companies are located. So we looked further and we found, of course, alternative ways of doing something similar. One of them being a method advocated by Alderson and Beckfield. And what they suggest instead is using data on ownership of subsidiaries by parent companies and mapping out these sorts of ownership ties, if you like, among cities. And that's what they do in their study for the for the top 500 M&Es at the time. And obviously got a very good paper out of it, I believe published in American Journal of Sociology. However, we still felt that yet again, it's kind of shared similar issues where obviously you would imagine that there are interactions among parent and subsidiary companies, but yet again, they had to be assumed and could not be easily quantified. So we kind of saw these two methods as kind of sharing very similar shortcomings. So we decided to kind of carry on with our search, and this led us to a proposition that instead of either using data on offices or parent and subsidiary companies, what we could do is to look for data which relate to co-production of financial services, and most importantly, they should relate to co-production in a manner where multiple firms co-produce a single service. So here we feel that this is a much close representation of actual interaction, because we can observe that these companies have worked together and have produced a service, rather than just gauging such interactions from the spatial organization of firms. And of course, yet again, it's nice to have ideas, but it's even better to have data and to be able to operationalize them. And what we've decided to do is to use data on underwriting syndicates to operationalize this concept of inter-organizational projects. And underwriting syndicates are effectively groups of underwriters, so these are investment banks, that jointly underwrite a single offering. So this means that, for example, when a company goes public or issues equity shares, issues bonds, this transaction is not handled just by one investment bank, but by a group of, say, 5, 10, 20 investment banks that share the risks and rewards of the offering, and that jointly sell these securities, excuse me, to investors. The advantage of doing this is not only that by looking at co-production of financial services, we have a much more direct representation of interactions, but also there is ample data available, and there are, for all practical purposes, comprehensive records available of co-production of certain types of services. So what we can do without having necessarily to hand collect network data, we can derive these interactions from data on financial transactions which feature multiple service providers. And also the concept of underwriting syndicate is well theorized and well understood. So we can draw on existing literature in financial economics and actually have quite solid micro foundations for how they operate, and we can build from there rather than not having these solid foundations to build on. So what we've done to actually operationalize such analysis, we have obtained data on 1.7 million interactions among investment banks and issuers that covers 540 cities and captures both revenue and network ties among financial centers. So with this data, we have been able to produce some quite interesting maps that cover the whole world. So these are global investment banking networks, and we can definitely, as we've learned, do more with this than to just create pretty pictures. So when we look at something like this, of course, there's only so much that one can infer from this visualization, right? But by kind of drilling into things a bit, we can get closer and kind of more interpretable views of the network and connections within. So here, for example, we were interested in the positioning of China's financial centers in this network, and their ties to both financial centers outside of China and to each other. And here you can see quite nicely both what the network looks like within China and what are the key nodes and connections among them. But we can also see how China is connected to the rest of the world, to New York, to London as the world's major financial centers. And by going back and rolling things back to 1993, we can also see that things have not always been quite the same, and that the mainland financial centers in China have effectively not been of any meaningful size back in the early 1990s. So just to review some results that we got from some of our papers. So in order to go kind of beyond description and plotting charts and making network visualizations, we also wanted to explain things. So we're interested in how does positioning of financial centers in investment banking networks affect their growth. And what we found, that financial centers very much benefit from being connected to each other. So they benefit from the resident firms connecting with their peers in other financial centers. Interestingly, density of network ties within financial centers does not affect their growth. And financial centers with assortative intracity networks grow faster than those with disassortative. And what this means is that financial centers were kind of the most connected firms mainly collaborate with each other and not with the peripheral firms actually perform better than financial centers where there are more ties across the core and periphery of the network. And what we find that this actually contradicts what's currently known or how we think about cluster networks. And of course, to be fair to this research, it was not developed in the context of finance. So this is not to say that these studies are wrong, full stop, by no means. But what it means that what's currently known about clusters, given the bias of this literature towards manufacturing and knowledge-intensive industries, may not necessarily be applicable to finance. And that's an important point, because we can't necessarily just freely translate frameworks and theories that were developed for other types of industries into finance, but instead we must inform financial geography with financial theory rather than many kind of more general theories in geography that have been kind of developed with different types of industries in mind. We then rerun a different study on connectivity and growth, this time at firm level for the UK. We cover over 3,000 financial services firms. And effectively what we are interested here is how does this work at firm level? So how does network connectivity affect individual firms? And what we find that better connected firms grow faster, surprise, surprise. We also confirm the finding of the other study that I've just talked about, that actually it's the inner city rather than intracity ties that contribute to growth. So this very much corroborates these findings. We also find that co-management rather than lead management appointments contribute to growth, as these kind of lower level appointments in syndicates open access to new clients and new market segments, while lead management appointments are generally given to banks that already have existing relationship with the given client. And interestingly, so this is something that we couldn't have really found in the other study, as it's done at city level, and we cannot really drill into this level of detail. But here we find that well-connected firms stifle the growth of lesser connected competitors that are located in their financial centers. Also, what we done, we looked at the connection between network connectivity and international trade in equity underwriting services. So here we started with, our starting point effectively was what's known about international trade and how distance relates to trade. And it's already quite well established that in goods trade, the trade decreases nearly, it effectively halves for every doubling of distance among trading partners. This is understandable, as obviously transportation costs are an issue within goods trade, But rather surprisingly, the same thing has been found in international finance. So why does trade in finance, financial services and financial assets, why does it also decrease nearly as much with distance as trade in goods? Of course, transportation costs are not the same sort of issue and should be negligible in finance compared to trading goods. So we collected data on issues of equity securities across 145 countries for 16 years. And we came up with effectively a very good representation of trade flows among countries. So this is basically a representation of how countries trade with each other. And these are flows of equity underwriting services. So for example, if you look at the US as the major exporter, we can see all the different countries that US exports equity underwriting services to. So what we find, we also found actually that geographical distance actually statistically significantly impacts patterns of international trade equity underwriting services, which kind of confirms what previous studies have found. However, we found that this is really only due to failure to control for factors that impact information frictions. So things like differences in institutional environment or network connections among countries. So what we find that once we account for institutional environment and networks, geographical distance does not play a role anymore. So this is not to say that trade in financial services doesn't decrease with distance, it does, but it doesn't so for distance's sake, but it does because of these two factors, which basically explain away the distance effect. This is of course in contrast with previous findings. And even in previous studies, they kind of concluded by saying like, yeah, we found this distance effect, but we think that it's because information frictions, yeah. But in our case, we managed to actually show this empirically and explain away the distance effect. And as my last paper that I would like to go over, if I still may, is on kind of the dark side of investment banking networks, if you like. And this is a paper that has been recently accepted for publication in Competition and Change. And it looks at how investment banks can actually take advantage of their strategic positioning in investment banking networks, and how they can use this to extract rents, so to extract value from issuers and investors alike. So can they do it? That's the big question, right? And even more so, how? So what we initially find that the direct and indirect costs of initial public offerings are substantial. So the average gross spread, so the kind of direct fee, if you like, that an issuer pays to an investment bank is 6.1% in our sample. So this is 6.1% of the value of the securities being issued. So this can be a rather substantial sum. And other studies find that, for example, for the US, this is even higher. It's typically about 7% for US. We have an international sample, and for us it's 6.1. Even more interestingly, IPO underpricing is on average 26.3% in our sample. And what this is effectively the difference between the price at which the securities are initially sold in an IPO and what they are then worth, what's their market price at the end of the first trading day. So this is effectively the money left on the table by the issuer. So we cover nearly 3,000 IPOs over 1998, 2017 across USA, Canada, and Europe. And we propose this kind of model, if you like, of rent extraction. So this is our proposed mechanism of how investment banks can extract rents from issuers. So up here, there's an issuer who initially transfers its equity shares to an investment bank that underwrites the offering. And the investment bank doesn't pay the issuer the full offer price, but it actually reduces this price by gross spread by those 6-7%. Then investment bank sells these securities to initial primary market investors, and these investors get the securities at what is oftentimes a bargain price, because by the end of the first trading day, these securities will be worth on average 26% more. So effectively, this gross spread and underpricing can be seen as kind of parts of the value that's transferred initially from the issuer to investment bank, and then later from investment bank to primary market investors, that may carry some element of rent. Of course, it would be unfair to say that all of this is rent, because this is to cover the investment bank's costs and compensate it for the risks of underwriting the offering. And similarly, investors need to be in some way compensated for buying securities for which there is no established price yet, right? However, what happens? These gross spreads and underpricing vary widely across offering, as we find, and not just based on characteristics of the offerings, which kind of proxy for risks and costs of everybody involved, but they vary alongside of dimensions that measure power of investment banks and their connectivity to institutional investors. So the kind of old hat finance theory and the signaling theory suggests that if there is a reputable intermediary, this should reduce risks, or at least perceived risks, and should shrink risk premiums demanded. Yeah. So if an investor demands a risk premium because there isn't an established price for a security, this premium should be lower if the investment bank is more powerful, more reputable, better connected, right? But what we find, and also what some other studies find, is quite the opposite. That actually better connected investment banks oftentimes underprice IPOs more, so they effectively extract more value from the issuer and pass it on to primary market investors, so effectively institutional investors that are allocated shares in the offering, and these allocations are fully discretionary at the level of investment bank. And this seemingly doesn't make sense to begin with, right? Because investment banks are reducing their own compensation by doing so, and are passing on a lot of value to primary market investors, which cannot be justified along the lines of risk premiums. But what really happens, as has been documented, that primary market investors pass on soft dollar commission back to investment banks, and this happens through either like trading fees or analyst research fees, and they effectively share out about half of the value that's transferred onto them through underpricing back with the investment bank. So this is a more kind of intricate mechanism that one could initially picture, perhaps, but it's been documented both through our study and some other research on the kickback channel, that this is how investment banks that are in particularly powerful position in the marketplace can extract value from issuers and institutional investors. So in terms of empirical evidence, what we find that investment banks with higher market shares and stronger ties with institutional investors are able to extract more value from issuers, primarily through IPO underpricing. Just to put this into a perspective as to what sort of money is at stake. So we estimate that a 10% increase in network connectivity of investment banks is estimated to lead to additional $8.3 million being extracted from an average IPO. And these gains are kind of shared out almost in equal measures among institutional investors and investment banks. And interestingly enough, about 3/4 of IPOs in our sample are underpriced. So this just kind of shows how widespread this practice is. So just to conclude very quickly. So as I've learned through my various research projects, there is quite a lot that one can do with data on financial transactions, and I feel that it has certainly opened up new frontiers in what's possible and what we can do within a field that suffered from shortage of suitable data sets and of large sample quantitative studies. Obviously, this goes well beyond measuring revenue and grounding transactions in space. We can learn a lot about relationality and networks, which I find to be even more interesting. And we find that positioning of investment banks in urban networks certainly has implications for both firms, financial centers, and countries for their international trade patterns. And of course, this is not a job done. So there are many questions that remain, yeah, that I shall be hopefully investigating going forward. And of course, everybody else is also welcome to join. So for example, how will London be affected by Brexit? Will Shanghai become one of the world's leading international financial centers? Will the COVID-19 pandemic radically reshape the spatiality of finance, perhaps? We shall see. So that's all from me, and I'm happy to take questions. So if David would like to take over the moderation.
Yes. Thanks a lot, Vladimir, for your presentation. There's already a number of comments and questions in the chat. Let me just take them in order. Was a comment from Karen on the position of Hong Kong. Karen, do you have a question hidden beneath that comment?
No, it was just a comment, but it was good. It was nice to see the contrast with the 93, I think, network maps, right, compared to was it 2016? So that was kind of really nice visualization, quite stark there.
Yeah, I definitely really like looking at these two kind of next to each other, because it really shows you that effectively mainland China has kind of come seemingly out of nowhere, yeah, with its financial center network, and it really has. I mean, if you think of it, like early 90s were the years when China's mainland stock exchanges opened up, right? So it's quite understandable that they were not really on the map as yet in 1993, and now they actually 6 of the top 20 financial centers in the world are Chinese now. So it's quite an astonishing change.
Just a follow-up comment. I think it's also quite important for us to remember as financial geographers, when we look at these kind of data sets, that a lot of these trends and network ties that we're seeing and how it shows up in financial center development is a reflection of much broader economic growth and processes as well, right? Because a lot of that is explained by the huge economic boom and actual production activities and investment activities going in and out of China over this time. So sometimes quite important for us looking at financial geographies to think about the underlying broader economic processes too.
Absolutely, yeah. I mean, very much, you know, as I've shown with the revenue breakdown of Chinese financial centers, like this is all built on domestic demand, yeah. So domestic companies are growing to the point that they can actually become publicly listed and issue securities. So it's very much home-driven growth.
Thank you, Karen. Thank you, Vladimir. There's a question from Dimitri Karpakis. Please, take the floor. Dimitri?
My question was if you identify
Let me just read the question. So the question from Dimitri is, did you identify a relationship between the development of financial centers and the broader regional structure of the country? And are there any patterns emerging?
Yeah, so the probably very short answer would be no, but not that there isn't one, but we haven't investigated this yet. So so this is yet an open research question.
And then maybe following on, Michael Grote, do you want to ask your question?
Yeah, thanks a lot, Vladimir, for this very inspiring talk. So the you were showing and stating that it's mostly external factors to financial center development that drive the fate of the financial centers. How would these positive externalities factor into this? Like you have, it would be a financial center becoming more attractive the more banks there are. Do you find anything like this, kind of a dynamic involvement or positive sign for a head start of centers also on an international comparison?
Yeah, so just to clarify, so what I meant was that the kind of the initial results that we got from our first study kind of captured mainly factors that are kind of out of control or out of direct control of financial services firms. Yeah, so that's why I said like things like institutions, yeah, or the clientele that was available, labor markets, and so on. But later, as we kind of drill into the factors that are in hands of investment banks, of course, we get lots of interesting results on networks. But also, what we find as a byproduct, if you like, is the role of localization economies. So we find that both clustering of related sectors, sort of the broader financial and business services, aids financial center growth. But also we find that there's a very strong relationship between size and growth of financial centers. And what it implies is that bigger financial centers grow faster. So there's kind of this like accelerating growth as they grow bigger. So this is obviously something very much tied to positive external sort of localization and of advantages associated with scale. Yeah. So yeah, so this was not to say that it's out of the hands of financial services firms, but it was still kind of underdeveloped to begin with. Yeah. So that's why we kind of decided to carry on and extend our research in this direction.
If I may, just to follow up on that, and because you also find that if there's in financial centers, there's a successful firm, may actually limit the growth of smaller firms.
Yes.
To what extent is there an effect of some kind of winner takes all syndrome there, where at the point where you have sufficiently large firms, they can install, you could say, gatekeeping practices, preventing smaller firms either within their own financial center or other financial centers to grow further? Because it seems that also in the rent paper, there are patterns that it's mostly the larger connected banks that may be in the position to do some gatekeeping.
Yes, absolutely. So it's not quite a winner takes all, as in one winner takes all, as it seems to be in case of some digital platforms, yeah, like social media and so on, where it seems like whoever is the best just kind of gets all the clients or most of the clients. So in investment banking, it's probably better said that the core of the network takes all or takes most. So it's very very relationship oriented industry, where we don't see evidence that it would be kind of all collapsing into sort of one ginormous investment bank or a single financial center. But there is definitely the tendency towards the core of kind of relatively small number of very well connected and very large investment banks to kind of to dominate the industry and dominate each financial center. And I would say if you have these types of dominant service providers, they definitely intensify the level of competition in their financial center. So it then makes it more and more difficult for smaller firms and newcomers to compete.
I saw a comment from Ilan Talmud. So Ilan, could you elaborate a little bit on your suggestion about running a block model on the network?
Yes, I'm not a geographer, may I stress. I'm an economic sociologist, and it's very customary in network analysis to use some sort of variation on the concept of structural equivalence in graph theory, mainly to discern to what extent, let's say, actors, let's say firms, who are in the same location in terms of contrived space, same location in the network, have the same outcome. You may, if you have time-dependent data set, then you may use also variation of it, let's say R Siena in R, to estimate to what extent structural properties as well as firms' attributes affect different outcomes. That's the whole point.
Thank you. Vladimir?
Yeah, so I've studied actually these network models, and what I find is that there are kind of two ways of going about this type of research. So one is to look at the network structure as something that we are trying to explain, and the other is to use positioning of individual nodes in the network structure as an explanatory factor. So the work that I have been doing so far very much falls into the latter category. So we have been using various measures of network centrality and various types of connections as factors that would explain things like firm growth, financial center growth, that would explain the pricing of these transactions. But we haven't yet done any research on explaining the network structure, yeah, where we would use things like block models and Siena. So this is still something that is even for us a new frontier. Never mind for the field, yeah. So this is something that kind of is still on my to-do list, so to say.
Thanks a lot, Vladimir, for your reflection on that. I'm quite sure that we're only scratching the surface of the whole issue about investment banking and how it intersects with power relations, both in the industry with outsiders and between financial centers. I think we're running close to the end of this session. So I want to thank you for your presentation, and I hope that the questions also help you to further your research. So thank you for that. There's 3 more small pieces of information I would like to give. Also, please refer to the chat for some more information. So the first thing is that our next virtual seminar will take place on the 2nd of March with Jesse Poon, and you can register via the RSA website. We'll also be hosting or organizing a FinGeo session at the RSA e-Festival, which will take place online in the period between 2 and 18th of June. So a long period there. So we'll still have to decide when exactly our session will be planned. So, but there's a call for papers out, and you can apply with your paper. And immediately following this session, there's an opportunity for some informal networking. And it's again in the chat, there's a Wonder Me space, and you can just click on that link and you'll end up in that space for some informal chatting and talking. So thanks again to Vladimir, and also thanks to my co-organizers Karen Lai, Dariusz Wójcik, and Duncan Lindo. And thanks a lot for the Regional Studies Association for their sponsorship and technical support. And I hope to see you on the 2nd of March in full force. It's goodbye for me. Thank you.